Welcome to the Apprentice Trading Library. This segment will explore stagflation, the worst of all economic situations. Stagflation is a complex economic phenomenon characterized by the combination of three seemingly contradictory factors. Stagnant economic growth. The overall economy experiences sluggish growth, often manifested as low or negative GDP, gross domestic product figures. High inflation. The prices of goods and services crucially rises, eroding purchasing power and consumer confidence. And high unemployment. A large portion of the workforce remains unemployed, adding to the economic woes and social unrest. These contrasting factors make stagflation particularly challenging to manage. Traditionally, policies to reduce unemployment often involve increased government spending or lower interest rates, which stimulates inflation. Conversely, policies to tackle inflation typically involve higher interest rates or reduced spending, which can dampen economic activity and increase unemployment. Let's consider the causes of stagflation. First, we have supply shocks. These disruptions to the supply of essential goods, like oil or food, can trigger price increases and hinder economic growth. Next are wage price spirals. When workers demand higher wages to keep up with inflation, businesses raise prices to cover costs, creating a self-perpetuating cycle. There is excessive government spending. Uncontrolled government spending, coupled with inadequate tax revenue, can lead to inflation without stimulating economic growth. And finally, monetary policy errors. Central banks' efforts to manage inflation or stimulate growth can sometimes have unintended consequences, leading to stagflation. Next, we will explore the impacts and effects of stagflation, which can be severe. For example, reduced living standards. Rising inflation erodes the value of wages and savings, making it harder for individuals and families to afford basic necessities. Business uncertainty. Companies struggle to plan and invest with volatile economic conditions and high inflation. And social unrest. Stagflation can fuel social discontent and unrest, particularly among vulnerable groups disproportionately impacted by job losses and rising prices. While relatively rare, let's take a look at some historical examples of stagflation. In the 1970s, several developed economies, including the US and UK, experienced stagflation due to factors like the oil crisis, wage price spirals, and expansionary monetary policy. And in the 1990s, Japan faced a period of stagflation following the bursting of its asset bubble, with prolonged economic stagnation and deflationary pressures. So how do we address stagflation? There is no one-size-fits-all solution, and the specific policies depend on the underlying causes. However, general approaches include addressing supply chain issues, such as increasing production, diversifying sources, and investing in infrastructure. This can help stabilize supply and prices. Another approach is balancing monetary and fiscal policy. Central banks and governments need to carefully calibrate interest rates and spending to address both inflation and unemployment. And structural reforms, where long-term economic reforms aimed at boosting productivity and competitiveness can improve growth prospects and help manage inflation. Stagflation remains a complex and concerning economic phenomenon. It is crucial to understand the causes, impacts, and potential solutions for navigating challenging economic times and promoting sustainable growth and stability. Thank you for watching the Apprentice Trading Library. Please visit verifiedinvesting.com for more.